Hello everyone, my name is Siddharth. I am working as a senior investment analyst in Growcent. I would like to welcome you all to our next session, Corporate Venture Funding Round. Let's welcome our panelist for the session, Mr. Siddharth Mehta. He is an investment professional with experience in private equity, venture capital, and startup accelerator in India and US. He currently leads India Hub for Shell Ventures and evaluates startup investments in mobility, logistics, power, and environmental sustainability sectors. He had led Shell's investment in Rapido, Magenta Charge Grid, Zip Electric, and Detect Technologies. Next, we have Mr. Ganesh Pagar. He is founder of CityLink Tech Solutions Private Limited. So, without any further delay, we'll start the session. Hi, Siddharth. Thank you for joining.
Hello. Hi.
Please share something about you and your company.
Sure, absolutely. Thanks. As you mentioned, I represent Shell and Shell Ventures and the startup program for Shell India called E4. We in Shell India have been looking at startups across the spectrum. So right from the early stages, which are kind of a pre-series A or a seed stage, to even the mature funding rounds, which are typically for a corporate venture capital arm. So investing in even Series A to Series C and Series D kind of companies has been our forte. Kind of pieces what we look at Shell are pretty much in logistics, mobility, power sector, energy solutions, clean tech, and future technologies in the mobility and logistics space as well. Won't go into much details, but very broad areas and investments ranging from right from $1 million to $20 million check sizes.
Okay. So first, my next question is to you, what is corporate venture and how they select startups and what they mostly differentiate from the ventures and others?
Absolutely, I think great question, right? I mean, there's always this this question amongst the startup as well that hey, should they approach a corporate VC or should they approach a financial VC? And I think it's important to understand what exactly is the difference between the corporate VC. And most primarily, I mean, corporate VC is kind of a smart capital, what I always say. So it's not just a financial investment, what the corporate does in a startup, but it's along with the financial investment, they bring the strategic benefit, what a corporate can bring to them. And that strategic benefit can be in the form of technical development. It can be in the form of product development support, a go-to-market strategy, even customer acquisition play, even being the first customer, or even to the end, a possible acquisition. So it's not just financial support, but it's a support in the growth of the company, what the corporate kind of devotes in the company. And it's a long-term association. So a corporate VC is slightly different from a financial VC, whereas the financial VC will always go with the intent, a primary intent of a financial return. A corporate VC will mix the financial return along with the strategic benefits what the startup can give to the company. So that's the highest level view, of what a corporate VCs are. There are different models what are existing in the market. There are some players who kind of primarily go only with the financial returns. There are people who go with very at the end of the strategic returns and they don't care about the financial returns at all. So we have seen different models. I think the best what Shell has adopted is a mix of both, where we always seek financial returns, but at the same time go with the strategic intent in mind.
Okay. Mr. Ganesh Pagar, same question to you. What your thought about this?
Yes, what Siddharth said, that's exactly right. In a corporate venture capital, right, the primary goal of their, if they want to expand the business in the different products, or if they want to enhance the existing product, or if they want to have good financial returns, right? That's what corporate venture capital jumps in. So there are many banks, right? If we talk about the banking sector, they are investing lots of in the fintech reason. Their current products are outdated, and to change the new product or upgrade the existing product, the higher cost is involved. So it's better for them to invest in the startup ecosystem, get the good fintech products, which is tested by the n number of users, and enroll, get added that product into their bank. This is one example of fintech. Similarly happening with the automobile sector, where the companies are the electric vehicles, and there's a lot of automations happening in the automobile sector, right? So all the big corporate companies in the automobile sector, primarily in the German, USA, and the Japanese makers, they are investing in the startup ecosystem. For example, the battery manufacturing, or maybe the driverless car, the technologies. So they are investing into that companies so that in future they can adopt that product into their businesses and they expand their businesses. So this is what my understanding about corporate venture capital. But as that said, right, there are a lot of things again get involved in that, the return of the company, right? If they are investing, how long it takes for the return, what is the stage of the company. Again, it varies from the each corporate venture capital to venture capital.
Thank you, Mr. Ganesh, for that. My next question to Siddharth. As a CVC, what do you mostly look in a startup before doing any sort of investment? What are particular things you look for in them?
Yeah, sure. And I think I'll kind of just like to build on this question, that why even a corporate is willing to work with a startup. I think it's a very important perspective for these startups to understand that, hey, why corporates are really fine, be it in the form of investments or be it in the form of accelerator program or incubation support. So I think at least in my view, there are three very important reasons why corporate would be willing to work with a startup. And then I can say, like, what exactly are we looking in those startups when we select them. So the most and the foremost reason is that corporates are looking for innovation. That, hey, how startups can bring innovation within the large corporates, because the corporates have been in existence for many years. They are struggling to kind of find innovations, and they want some external or inorganic growth. And startups can provide them that excellent view of what's happening, what's the most innovative solution happening on the ground, and so that the corporates kind of don't lose the race of innovation. That's number one. Second important reason why I would say the corporates look for startup is also to build that spirit of entrepreneurship within the organization. The startups, as soon as you start working with the startups, you bring that agility, you bring that external perspective. So a lot of those entrepreneurship culture, which helps getting built in the organization if a company or corporate starts working with the startups. And then third, absolutely, there's this financial return concept for sure, right? That, hey, I mean, people are looking for financial returns by investing in these companies. So given these three views, I would say the most important thing what we will look in a startup is the quality of the team and the founders. I think especially in the early stages, the quality of the team is the most important factor. What kind of an expertise the team has, are they really complementary kind of benefits, or the complementary skill sets among the team members. So having the right team is very important thing. Second is the kind of market they're targeting. How large is the market, and is the problem what they're solving is really a problem to be solved, right? Is it a large enough problem to be solved? So understanding the market and problem is second most important thing after the team sizes. And then third is their execution ability, right? That, hey, how they have executed it, what is exactly their unique advantage over the competition. So having a very clear view on who are the competitors, how do you kind of differentiate from your competition is very important. So I think if I want to focus on top three, these are team, market, and problem, and third is competition and differentiation is very important when we look for startups.
Mr. Ganesh, Pagar, your thought on this question?
Yes, what Siddharth said, I completely agree on this one, right? Whenever they want to make the investment for any, it's not only about corporate venture capital or VC or the private equity, right? Every investors, I just want to ensure that how my funds will be get utilized, and what is the next return, or how I will get benefited, right? So if you talk about this thing, so the underlying umbrella, right, the things they look into that, the most important is the team, what kind of experience they have, and is the team is not like the single person is running the business. It should be the different peoples, and they have the expertise in the different in the different fields. Second thing is the speed of execution, right? How quickly they adopt the new changes. So any startup, they make the product. The most challenging part is when they enroll it in the production, and when the customers start using it. That's where the challenging is, right? How customers are using it. Are the customers facing any issues? What is the customer feedback? Adopt that changes, and make the product more stable and make more usable. So where this is the where challenge is for the startup ecosystem or the founders to identify the gaps, fix it as soon as possible, and make that product or the features available in the market. Third thing is the market size, right? So what happened in many times, right? We introduce the product in the market, and if we do not have the market, then it just the startup ecosystem get collapsed. So before that, they need to do some analysis. So it might possible whatever product I'm launching, similar product may be available in the market, but we have to identify the gap in between. Okay, this product is available, but what are the features are not available in the competitor? What are the new things I can add it? And this will get benefited to them, to expand the product partially in the market. Something is scalable, right? It should be scalable, and it should be ready to deploy across the geographies, irrespective of the particular, the one nation or something. So it should get deployed to the different geographies, and the customers can use it. The third important thing is the revenue of the startup, right? What startups need to focus on this to sustain in the market on the revenue side. There are many products are available, but the revenue is low, and the startup will not be survived. And if they have good revenue, again, they have to show to the VCs or to all the investors to year growth of the startup or month-to-month growth. That's very important. It's not to be like, oh, 1 month I got a good revenue, second month I don't have, third month I got a revenue. So it's an unpredictable thing, right? So they have to be focused and should be predictable. So whatever the plan, the strategies they are decided in the beginning of the year, they have to execute it. Sometimes it may not be met because the circumstances beyond their capacity, which is understandable, but they have to do a solid plan and they have to put their efforts to execute that. And this is what, you have a solid revenue, you have a good team, product is scalable. And I think that is a good thing for the investors to look into that things, and they will invest the money in the startups. And that is the foremost criteria every investor looks into the startups.
Thank you. My next question to Siddharth, as you mentioned, like mostly the CVCs prefer from the Series B to Series C, Series D. Is there any chance of the early stage startups that CVC tries to fund if they are having good business ideas and they are totally new into the market, the competitors are less? So what are the thoughts about that CVCs in the early stage? What do they evaluate about that companies?
No, it's very interesting, and I think I would say that there's no fixed paradigm for a CVC to only invest in a Series A or a Series B or a mature startup. I think there are a lot of corporates who also invest in early stage companies, and there are corporates who also kind of invest in the late stage companies as well. I think what's important is to first have a clear view on what exactly is the thesis of investment in your fund. And I think one of the most important thing is to understand that, hey, are we kind of looking for solutions which are deployable? Because, see, I mean, if you look from a corporate's mindset, they want solutions which are readily deployable in the company and which can give them benefits, right? I think which can give them benefits in terms of cost saving, or give them customers, or give them new markets or new models to play with. So I think that is for most important thing, when we think that what maturity corporate would be investing. Having said that, there are different units in the corporates which would also be looking at the longer term view. That is, solutions which have no future for next 2 or 3 years, which are still in the R&D phase, but still there are a lot of things which a corporate can learn from the R&D phase of a startup. So I would say absolutely yes, there is no golden rule that a corporate only invests in Series A or Series C or a seed stage company. In my view, they should be investing across the spectrum, because every startup and every stage has its own benefits, what a corporate can gain from investing in those things. To give an example, I mean, Shell is also invested in companies which are like Series C, Series D, as well as we have even a seed stage portfolio company, multiple seed stage portfolio companies. And then there are different ways of engagement. What we have with such companies which are early stage, whereas what are late stage is a different model of engagement as well with them. So I would say what really depends is, as you rightly said, I think, is it really differentiated product? Is the team really compelling? Is the market good enough? Is the solution has sort of differentiated proposition? Is it a sustained competition advantage over the others? I think for a startup, I would suggest focus on those things versus focusing on that, hey, I mean, is it a Series A, Series C corporate? I think if you can focus on getting the basics right, the fundamentals right, then every corporate would be interested in it.
And your thoughts about this, Mr. Ganesh?
So the corporate venture capital, right? So my understanding, what Sid said, right? It is on the similar line. Most of it is true that most of corporate venture capital puts the money in the startup that has proven the concept, and they have some customers. So Series A onwards, they looks in the startups. Okay, the startup is good. It is, again, they look in the different direction. Every corporate venture capital, right? So can we fit that product into their businesses, or can we get a good returns, or this is the new future that or new businesses, can we enter in the new businesses because if the market is good. So they look all the angles based on their requirement, and they invest in the startups. But sometimes what happen, it's not necessary only the Series A, Series B and above the companies, but early stage companies also, right? If they are doing the research and they have the proof of concept ready, then they startup, these investors also put the money into that companies. So for example, I have seen the many companies in the oil and natural gas or in the energy sector. They have make the clean energy proof of concepts. And for example, Indian Oil Company found that, oh, this is a good startup. They did a lot of research, and they are going good research, and this is good on the clean energy side. So they invested money in that company so that founders can do the more innovation and will come up with the good idea, design and good completion of the product. The similar thing on the energy sector, right? So there are many companies who are in the energy, they are investing in the solar systems because that is good market. So every house, right? We are calling out 3D printing. But along with the 3D printing, now every independent house now installing the solars, and that is good market for the startups or for any new businesses. So the companies that are in energy sector look for these companies who are in the new space, who are in the solar systems. So they go, okay, this is a good concept. They put the money in the early stages, and they get a good returns in the future. So again, it vary from the business to business, but if there is a new market and the startups are putting efforts there, definitely CVC also come and will enter in that market. And if they have already proven concept, and if the corporate venture capital find that, okay, it's allowing them into the business, or it's a good opportunity for them to enter in the new market, or if they find, okay, this is a good opportunity for them to invest and will get a good return, so they go and invest it. And it's not like one company go and invest it. So it might possible multiple corporate venture capital can come together and they will invest into the startup ecosystem. I see in the automobile sector, right? The existing brand, the big brand, they found that there is no way for one company to invest in the automation and the electric vehicles. So they formed the joint companies to innovate in the electrical vehicles and the automations of that vehicles, and they got a good result. And I see that there is good return to the Germans and the Japanese companies on that one.
Thank you. My next question, what are the other contributions that a CVC do other than investing a particular amount? To Siddharth.
Yeah, I think again it's a broader question. How CVCs kind of invest versus the financial VCs, and I think that's one of the core of the differentiation between a financial VC and a corporate. So in my view, there are I would say three important benefits. What a corporate can bring to a startup apart from the capital, and that's why we call the corporate always bring smart capital to these startups. So number one is all the technical and commercial mentorship. So it's very important, especially for the startups who are in the early stages, to receive that mentorship on the technical side or on the commercial side from a corporate. And corporate, being in the existence for so many years, can always bring that right sort of technical people from the partners, from their own network to help the company. So that's number one, all the technical and mentorship on the commercial side. Second is very important thing is the access to market. I mean, corporate again is by virtue of being present in so many countries or so many regions, has a tremendous access to market, and that whole go-to-market element, which it can support the startup with, is very critical. And again, when the companies are willing to scale up maybe from X to 10X revenue, that go-to-market and newer market access becomes very important. What a corporate can provide with its existence. So that's second benefit. And third is absolutely the whole customer base. Sometimes you have seen corporate becomes the first customer of a startup, or they can give their own customers to the startup as well. So access to customers is again, I think, one of the important things, followed by a international scale up. So a lot of times you've seen startups, which are kind of based in India, but they maybe work with a corporate, and then along with the help of that corporate, they're able to scale up to multiple other countries, or multiple other regions. Like, we have helped startups scale up to US, in Europe, in Southeast Asia, in Middle East. So that's where a corporate can really help startups with, is to help them in the scale up journey. So those are three very important benefits. As I said, I mean, access to customers, markets, international scale up, and more importantly, mentorship on the technical and commercial side.
Okay, thank you. My next question to Siddharth, like, how can a CVC financing contribute to financial liberalization in emerging markets?
Yeah, it's kind of a very, very subjective question, but I would say, see, if you look at the whole venture trend, how it has been in existence in the past, and I'm saying, like, say, if you look at, say, past 10 or 15 years, and I want to start off first with India and then, focus maybe at the rest of the world. But if you look at India, there has been a growing trend of how the venture money has kind of come in startups. But at the same time, if you look at the proportion of corporates investing in that whole venture money is still significantly low. So if we take, say, maybe 10 to $15 billion of venture investment coming into India every year on an average, out of that, maybe only 20 or 30% is kind of coming from the CVCs, and rest is coming from the financial VCs. So I would say that is, and if you compare that to the West, I mean, countries like US, I mean, where 80 or $90 billion are being invested in venture capital every year, corporates do play a very significant role in that whole venture investment. So there is still a kind of, India has to leapfrog, especially, if I look at India, I mean, it has to leapfrog from, compared to the Western countries in terms of the contributions what the corporates can make. The second important point here to note is, if you look at the corporate themselves, I mean, they are usually supported by a very strong balance sheet. And I think this is an important point to understand, that when corporates make startup investments, they don't kind of raise funds. They don't go usually in the external market and try to get investors to raise funds. Usually they're investing from their own balance sheets, and that balance sheet is kind of decently strong. So to get corporates engaged into the whole startup landscape will give the whole venture capital landscape a big boost. There will be more capital which can be infused into the whole VC landscape by engaging the corporates into the startup investment. So those are two of the very important premises, which we should be really aware of. The third thing, when you said, like, liberalization in terms of the whole startup operations and funding. So again, I think, just summarizing whatever we have discussed till now, is that engagement of corporates with startups also gives a very smart capital infusion into the VC world. And the more and more smart capital we have, I think that would be very beneficial for the companies to help grow, not just from the investment perspective, but even from the commercial and technical perspective. So having corporates into the, I would say, the startup investment is critical, and I think it would be really beneficial for the startups at large.
Mr. Ganesh, your thoughts about this question?
Yes, sure. So I will take it a little differently based on my understanding. For the startup ecosystem, right? If you look in the growth of the startup ecosystem, it varies from the geography to the geography. If you go to the European market, when anyone start the startup, they get very immediate funding, not from the investors, but government is ready to fund them at the initial stage. If you go to the North American market, the angel investors are flooded in the North America. They invest the money very easily in the startup ecosystem. But if you come to the South Asia, we have the little challenge for the early stage startups from pre-seed to, I would say, pre-series A. And even the Japan, I mean, whatever the developed countries in Asia that are good, but the rest of countries, there's a big challenge in the startup ecosystem to get the funding in the early stage. So if you talk about European market and any company, right, they are doing some research and want to come in the businesses. So they get very easy funding from government, and their crowdfunding is also available. So at least they will sustain in the market until they start generating revenue. Once they start generating revenue, it is easy for them to find out the investors, either it be the venture capital or the corporate venture capital. In North America, they get angel investors easily. So if the angel investor invests money about 300K or 500K dollars, so they can sustain it for 2 to 2.5 years. And that is a good enough amount of time to add up features and enroll the customers in the product and generate some revenue. And after that, they get early stage VCs and then VC and the corporate venture capitals. If you come to the South Asia particularly, it's very challenging for the startups to get investors. And we see through the Growcent platform, right? The many startups have been registered it here, but they do not have a revenue and they find it difficulty to get the investors. So to overcome to the challenge, the first thing on the Asian market, we need some government support. Already India has added some 1,000 crore. They need to put more money in the startup ecosystem, because I see the products are very interesting products from the startups, and they have the capability to change the innovations or to come with the new innovation and change the society. Many startups that have product that are in the direction of the society 5.0, the automations, robotics, maybe the blockchain, and in energy sector, mainly energy, healthcare, we see the lot of startups, right? They have the capability to disturb that sectors. The only thing is at initial level, they do not have customer base much and do not have funding, and they find the difficulty to survive. So here is the one thing, if we get more funding in these businesses, right, from the government, or we need to come more angel investors for initially, so that they can sustain it for next 1 or 2 years. And that will be the good baseline. We can see the more and more startups will go on the unique directions after like 5 or 6 years down the line. And if we talk about the liberalization, right, as a startup, it will be very challenging for them to go to the global market immediately, unless they have to do the tie-up, or they have to have the solid founder or solid investor. So the good investor, I will say the corporate venture capital here, because if I say corporate venture capital, they are already in the different geographies. They have the good knowledge on each region, right? What is the market size? What type of customers are there? And if you make a partner as a corporate venture capital, right? So it will be very easy for you to expand your product in the different geographies. And that's the benefit of the corporate. We have the backing of the corporate venture capital.
Thank you, Mr. Ganesh. Siddharth, my next question to you. We have seen there are very few corporate ventures in comparison to VCs. So there like some sort of challenges that CVCs are facing, or like.
Yeah, absolutely. I mean, as we discussed, I mean, the proportion of CVC money from the overall pool of venture money is significantly small, right? I mean, it's still less than 50% of the total capital pool. And there are a few very apparent challenges. And I would say, if I want to kind of point, the biggest challenge, number one, is the whole internal alignment within the corporate. I think it's very difficult, and we also have faced the same issues, when we launched the CVC and the startup program, is to have the alignment from the senior leadership on what exactly are the benefits of corporate venture capital and even the startup engagement. Because I mean, the corporate is going away from its traditional ways of working. Making or investing in startups is not what the corporate does as a day job. So it's a very different kind of a skill set. It's a very different kind of a work what they're doing, and having the buy-in from the senior management is really difficult at times. So that's one of the biggest challenge what a corporate faces. The second one is also having the right skill sets. Because if you look at the VC skill set, it's not something which you will find in typical corporates. It requires a different kind of, I would say, team. It requires a different organization structure. It requires a different skill set. So I think having that all these three things in place also is very challenging. And then the third is the whole governance of the organization. If you look at how corporates function and how the VCs function, the speed of decision making is very quick in a financial VC versus if you look at a corporate. Corporates will have their own bureaucracy, their own ways of decision making, their own structures in place. So to come up and to match the speed of financial VCs, and also to put that capital in, because you are in the competing landscape, right? I mean, you're competing with the financial VCs. So how do you kind of be at the same decision making, same quickness is very challenging. So those are three of the very biggest challenges, what a corporate faces when they kind of think about the CVC or the startup engagements.
I would like to hear thoughts about you, Ganesh. What are your thoughts about this?
Yes, I will look for the seats here also. So yes, the challenges mostly I have deep experience in the financial industry, right? And in the financial industry, how it works at the banks or any financial institution, if they own architecture also, right? Uh, they are very sensitive and they do not want to take the risk. So any product, right? They will use continuously until they find that there is no support is available in the market for that product. A reason because if a product is available in the market, there are customers and there are very less risk for the product, so they continue to use that. uh, for the new, they realize, okay, there is something new is coming, and how they invest it, they check with the other partners that what is the next direction, what we can do it. So they collectively decide, right? It may differ a little bit about the features of the product, but they collectively decide that is there any market for the product or not. And if they find, okay, the partners are saying yes, or other colleagues or competitors are okay, they find that, okay, this is good, and they collectively thought that, okay, this is good opportunity for the market. For example, the payment system or regulatory products, right? And then they go and invest in the startup ecosystem. And the next thing is they do not go and directly invest in the startup ecosystem. So they find out who is a good venture capital firm. Okay, and they put the money in the venture capital, allocate some funds in the venture capital, and through that venture capital, they make the investments. But if they find, oh, there are good marketer available, sometimes they create their own firm. For example, uh, City Investment is there, right? Even Dale Capital is there. So they created own financial arm to invest in the startup ecosystem. Most of the corporate venture capital currently is doing it. But what Sid mentioned, which is absolutely true, right? Like a venture capital, they do not have that much deep expertise, because the venture capital have the years of experience to investment in the startup ecosystem. The second thing is the speed of decision is slow, because I already mentioned, right? The risk, they are not ready to take the risk immediately because of their previous experience. They know that if the risk is involved and how it impacts to the reputation of the company, and it has very high chances they will lose the existing customers and will find a difficulty to get the new customers. So this they take the lot of things, being a big corporate company, so they have to talk to the different stakeholders, different head of departments, and they make the decision collectively. They make the decision and invest into the companies.
Thank you, Mr. Ganesh. Like now coming to an important question, like how CVC decides that it's time to exit from this investment?
Yeah, I think it's one of the most challenging thing, right? I mean, be it a CVC or even a financial VC, right? I mean, everybody is looking for an exit at some point in time, because that's really the end of the VC whole cycle. At the same time, I mean, how a corporate kind of differs from the exit thinking is that there are a couple of ways of exiting for a corporate. One is absolutely, you do a secondary sale, you do an IPO, or you do a typical M&A kind of an exit. Whereas there is another option, which exists for a corporate is the acquisition thing. That hey, if the startup is very strategically linked to a corporate, then even a strategic acquisition can give an exit to the venture arm. And I'm saying this from experience because we have done both these kind of an exits, where we had done an acquisition of one of our venture portfolio company, giving an exit to the venture arm, as well as we have done a lot of for those secondary sales and M&A kind of exits as well. So it's important. How do you kind of think from the exit lens? So one of the important thing is that hey, is my equity, is my investment in the company, or is my equity in the company has reached a stage where the financial returns are kind of the most optimal. I think that's one of the most traditional theory of venture investment, that hey, you look for 5 to 7 years where you think you have maximized your financial returns on the investment, and that's the point in time you exit. And you add a layer on top of this from a corporate lens, that hey, is having an equity in the company, is it critical for driving the future strategic value with the startup? And if your answer is no, that the equity is not necessary for a corporate to drive future strategic benefits, then you would look to exit. Because if you are in that zone where you think that, hey, I still need to have some ownership in the company or some investment in the company for me to drive that strategic benefit, then you are never in a position to exit that startup, right? And I think that that's one of the most biggest challenge what the financial VCs have with the corporates. That sometimes the way corporates think on exit is not driven by financial returns, but it's driven by the strategic value what the startup still brings to them, and that's the reason they don't want to exit those companies. So I would say, having that clear insight on that, hey, what is that strategic return? Is an equity in the company really necessary for that strategic return? What's that financial maximization you can have from that company? Are the important levers when we think for exit? At the same time, timing is important. You would want to exit in a timing where the market is right, where it doesn't give the wrong message to the other startups that, hey, you are exiting too soon or exiting too late, which can hamper the company either way. So having all those variables into discussion is very important.
Okay, thank you. Next, I would like to ask, like, how you select a particular sector? Like, we have to invest in this particular environment. Like, you selected like a socially or like in the profit. Hello.
Mr. Ganesh, if you want to pick this up.
Hello.
Oh, okay. Yeah, sure. I'll take that. Samir, again, it vary from the corporate venture capital, right? But what my understanding is that if you talk about corporate venture capital, they always have the one more arm for the corporate social responsibility, right? It may be the department within the company, or they create a separate arm for it, right? For example, Facebook founder, right? Instead of in the Facebook, he created own corporate social responsibility organization, and he invested through that firm. But here in corporate venture capital, right? Sometimes they have own corporate social responsibility, and they do make the investments. So whenever they make the investment, for example, the Facebook founder created corporate social responsibility, he makes the investment in the startup. Yes, he's looking for the return from that startups, but the primary goal is how that is impact to the society, right? What is the new customers they get it who are not financially capable, or no one has reached out to them before. So they identify these segments and invest in the startups accordingly, right? Maybe in the food, the startup is working the food system, right? So if they're reaching out to the underprivileged children or some bush areas, right, where they are giving the supplies, so that time they go and invest it. The second thing is, for example, there was a startup called, they are recruiting the people from tier 3 cities, where there is very less opportunities for work, because most of people from tier 3 cities migrated to the tier 1 cities for the job opportunities. But there was a startup ecosystem. I would say there is a startup ecosystem who is working on it, who is creating the remote jobs for the tier 3 cities. And there are a lot of companies come and invested in the startups because it is giving opportunity to the tier 3 city youth to do the job, and the economy will be good on the tier 3 cities, and more jobs will be created there. So it varies from company to company, but yes, there is a space to invest into corporate social companies where they will get good, not only good return, but whoever the community who is not known is reaching out there, or very few players are reaching out there. And if the startup is reaching out to that community for the welfare of it, and the principles, one of the principle of the United Nations, right? That there are a couple of principles of the United Nations. If it comes in one of the category, then yes, the investors invest the money into that startups with not intention to get a good return, but only to improve the lives of the society. And to get exit on here on other firms, right, in other places, yes, they have the different aspect. The primary objective is it should be in line to their business, so that they can integrate that product with their business, and they will have the good market capture, or they will not lose the existing customers to the new competitors.
Okay, thank you. My next question to Siddharth, like, What would be the best form of involvement of the state in the corporate venture capital market in a transition economy?
You mean state is basically the government sector, you mean, or?
Yes. Yes.
Yeah, absolutely. So I think, see, it is very important to have the right kind of a policy environment to support the CVCs as well. And just like there has to be a right policy environment for supporting the financial VCs, be it in terms of the taxation, what you get on the returns, what you make, be it the easiness of making investments into the startups. And I think more importantly, since you would realize many corporates what are operating in India have their headquarters outside of India. So a lot of times the money comes from outside India into India, and this is treated as a foreign direct investment into the country. So how do you kind of deal with the regulations of FEMA or the FDI regulations? How do you deal with basically the regulations kind of implying which sectors you can invest in and what sectors you can't invest in, and what are the procedural I would say delays what comes along with these investments. So those are very important things. How a state can support the corporate VCs. Absolutely, yes. Secondly, I think taxation is very important thing. I think it has well been discussed that hey, there is always a capital gains tax on the return what you make. So how do you kind of deal with those capital gains tax and the losses what the VC industry make? There has been a lot of debate on that element as well. And third important thing is looking from the corporate perspective, that hey, how the government can enable the support to corporates, just like government support financial VCs by the help of SIDBI, say example, they have a venture fund where, in the alternative fund AIF category, SIDBI supports the financial VCs as well. So how that kind of a support can also be available to the corporates is one of the important thing. Here, how the state can really support the corporates here. So yeah, there are a lot of I would say procedural and technical and regulation things, where this can be improved.
Okay, thank you for that. I want to know your views. Any message you want to give to the startups who are attending this webinar?
Yeah, I think a lot of things, I mean, one of the biggest thing what I always find when I meet startups is that they should be really passionate about what they're doing, because unless you are passionate, unless you are very convinced, and unless you are very clear, you will never be able to give that passion to the investors. So whenever you go and talk to any investors, be it a corporate investor or a financial investor, have that passion and that idea of what you're working on. Be really clear about what you're kind of working and how you want to scale up. So that's very important. Second, I think be very modest and humble. I mean, there's always competition. There's always people who are doing better things. Have a good visibility on what's happening in the market, what others are doing, how you are kind of differentiated. So have a very kind of a diverse perspective on the solution what you're also building. At the same time, being modest. So being passionate, being modest, having a great view of the whole ecosystem are very important things whenever you go and speak with the investors. Apart from that, there are some of the basic things, and I would say in terms of having a very good view on the investment case, looking at the market, having building a very solid team. I think there's always this debate between solo founders and having the right kind of a team. I'm of the view that having two founders and having the right team is very critical because it kind of brings very complementary skill sets. So focus a lot on the teams, which is very critical for success.
Okay, thank you, Siddharth. Let's ask the attendees if they have any question. Same time, Mr. Ganesh, do you have any thoughts on what message you want to give to the startups who are attending this?
Yes. My message to the founder, right? First thing, I would like to congratulate them for initiating right to business, starting the business. That is the most important step. I think 70% people don't take the decision that one. The second thing, to get its success, the consistency is very important, and to passionate towards the work. That is the most important key things. Third thing is, as a startup, as a company, one person cannot take all decisions. So they have to get the experts as a partner within the company, or maybe as an advisor or as a colleague. They have to be with them so that they can give their inputs on the different sector, maybe the marketing, technology, on the security, regulatory risk, right? So they get inputs accordingly, and it helps them to make their product better. Third thing is, yes, investor comes and invest it, but for most important thing is for them, investor is the customer. So they have to talk to the customers, to speak with them, get a feedback, and put efforts to make the product more scalable. That's the thing. And the last thing is look for the other opportunities. Talk to the maybe look in the market what is trending, and try to adopt that new features. It will help them to scale up the product very quickly, and it will get them more visibility. So when to get a success, I will again say that never give up. Only will say you will fail whenever you give up. If you are consistent and innovative and passionate about your product, I think no one will stop your the product growth or the startup growth.
Okay, thank you, Mr. Ganesh. I just wanted to ask, like, if you have any queries, you can ask Siddharth.
I will say, I don't know. I think Samir, you covered very good points and covered all the aspects. Sid, your experience is very deep, and I think you have given a very good insights in the corporate venture capital. I think very few startup ecosystem knows right how corporate venture capital works, how they invest, and what kind of strategies they need to use to reach out to the corporate venture capital. And I think you have given the very good insight for that one. So thank you very much for your time and giving us all this insight.
Oh, wonderful. Thank you so much, Ganesh. It's been a pleasure being with you on this panel. So thank you, and thank you for giving the opportunity.
Thank you, Ganesh. Siddharth, any point I have missed that you should, you're thinking that everyone should know about the CVCs? Anything the point
Yeah.
I missed?
No, absolutely. I think you covered almost all the important elements, and I try to kind of give a good overview of how CVCs train, how Shell Ventures train, how Shell has been engaging with the company. So I think very well covered session. If there anything, which the audience wants to kind of connect, I think feel free to reach me on LinkedIn. I think would be happy to kind of connect with them.
Okay. It seems there is no questions from the attendees. I think they might have all the thoughts and all the questions. Okay. Thank you, Sir Siddharth.
Wonderful.
Thank you, Ganesh, for such an amazing session. Thank you for being with us. And thank you everyone for joining this session. We have our next session scheduled. Okay. So
Wonderful.
please
Thanks.
kindly join.
Thank you. Thank you. Thank you, Sid. Thank you.
Thank you.